Hey everybody, it is Lawrence from FinancialThing.com. It is Friday, November the 7th, 2025. Welcome to the Financial Thing live stream on YouTube. Welcome. It's a beautiful day outside here in Orlando, Florida. As you can see, it is about 28 degrees, sunny. Some clouds in the sky looking like an art painting out there. So sorry if it's cold in the UK. I don't mean to rub that in. I sincerely don't. I hope it's the weather's treating you well. Anyway, yeah, we missed a week last week. Had personal things to do, but we are back. Yes, we are back, and we're going to talk about investing. We're going to talk about peer-to-peer lending. We're going to talk about the stock market. We're going to talk about some Bitcoin news. We're going to talk about London House Exchange. We're going to talk a little funding secure, a little loan pad, a couple of letters from the mailbag as always. So if you could do me a favor, you know what to do. Do I have to ask? Just hit that thumbs up. Takes a second. Gives us a little push in the rankings. You know, we're like, imagine Grimsby Town in the 3rd division at the bottom, and we get a couple of wins and we get moved up into the division a little bit. That's what happens when you hit that thumbs up button. So anyway, yeah, it's Friday today, by the way. Normally here on a Thursday, but the schedule is what the schedule is. Should we just get straight to it? I don't know. Should we? We should just get straight to it. By the way, if you didn't hear last 2 weeks ago, we had Neil Faulkner here live from Fourth Way. If you haven't watched that video yet, go back in the archives. Watch it again, too. It's a ton of good information on there, I think. A ton of good information about what's going on in peer-to-peer land, what's going on in our sector that we've religiously followed, myself, since 2015, 10 years ago, a decade. Now coming into 2025, where things look a little stagnant. Things look a little bit quiet in our beautiful peer-to-peer lending sector that we've studied for so long. So go check out that interview. I don't think any other channel has had Neil live and direct like we have here. So I think it's a blessing. I really enjoyed that. I hope you did too if you watched it. Anyway, a quick hi to everybody in the stream. If you are watching in the future, welcome. Please subscribe. We got Invest24 live here from a cloudy London town. What is going on in London? I see all these news stories out there about crazy things and takeovers and protests. We don't have that here in Florida. We've had some No Kings protests, but that's political stuff I don't want to get into. What is going on in London, though? Paul Bagworth is here in Kenilworth. Welcome. And Annabelle is here from a windy Costa Blanca this evening. We have other people watching too. If you want to say where you're from, drop it in the chat so I can give you a quick hi. Let's get straight into the news. It's the news. There's not much in the AlternativeCreditInvestor.com anymore about peer-to-peer lending. Generally maybe showing how little coverage the sector is getting at the moment. But here we go. Here's a story. SOMO, which I know some of you do invest through SOMO's loans. SOMO launches the UK's first capital loss guarantee on second charge loans. That is very interesting. You know, I've always been kind of down on second charge loans because I've never thought that the amount of interest that they pay you as an investor matches the amount of risk that you are taking as a second charge guarantee. So it's interesting SOMO have done this because, well, for two reasons. They want to get people to invest in second charge loans when generally second charge loans get a bit of a bad rep. So this is a good marketing ploy. UK bridging lender SOMO has launched a capital loss guarantee offering investors protection on up to the first 10% of any loss on second charge loans for property. The second charge limited capital loss guarantee, SCLCLG, will apply to all loans originated after the 1st of November 2025 with aggregate coverage capped at $1.2 million. Loans made before that date will not be covered. interesting that they've also made sure to highlight that was something Cufflink did not do when they decided to remove their first loss guarantee. They, said, "Oh, this is going to cover. It's not going to be for loans going forward. This is going to be for everything, including loans that were written in the past." So SOMO has highlighted that this will, in fact, only cover loans originated from November 1st. I'm imagining it says it originated after November 1st, so I don't know if that means November 2nd, but very clear specifications on that. SOMO says the scheme provides direct, transparent, and defined coverage, unlike more complex credit enhancement mechanisms, which that's word spaghetti for me. But the property lender added that it will also consider a limited number of second charge cases with loan-to-value ratios of up to 75% in line with market norms. They have a strong performance, apparently, of their second charge portfolio as of April 2025. 580 second charge loans have been repaid. That's a big number, with 100% of capital returned and 99.66% capital repaid with full advertised interest, delivering an average annual return of 10.33%. So, good track record, right? As of April 2025. I don't think it's much of a track history. We're talking about 6 months or so. Really, to see whether these things perform over the long period, you have to look at, has a company like SOMO been able to get these repaid for 5 years? But this is the data that they have. 10.33%. Personally, I think it's for a second charge loan, it's not great. It's okay. I personally myself would want to see 12% plus for a second charge, 12, 13, 14%. But 10.33% is what you're going to get average, but they do have this pretty strong track record of repayment for the last 6 months. By comparison, first charge loans recorded 532 payments with 100% capital returned and 99.06% repaid with full interest. This is the kicker, though, with an average annual return of 9.36%. So you're getting a little bit less than 1% extra to invest in second charge loans. So the issue with that is when second charge loans fall into bad debt, which inevitably at some point some will, you are in second position. So then that's why I say you really need to see a longer track record than 6 months, because if these loans do fall into troubled times, second charge loans are very, very difficult to get repaid if you have to go through the legal system versus first charge. And look at some of the companies that have had difficulties with defaults on first charge loans, how difficult they have been to be repaid. But there you go, decent track record for 6 months. To support the guarantee, SOMO will hold a dedicated loss reserve based on the size of its second charge loan book. The reserve will account for both statistical risk and potential market stress scenarios. So if you are looking for a place to get 10%, 10+% for second charge, SOMO is a spot you could do that. But just remember, you can also go to places like Blend Network and get first charge returns for around the same, right? 10%. Different type of loan, different type of structure, but it is there. So do your own research. It's not really peer-to-peer news, but I thought it was an interesting story. Senators in the U.S. are warning over risky alternatives in 401ks. 401ks are the equivalent of a UK pension, a private pension offered by companies. So you get a tax-deferred way of investing, and usually in the U.S., they do these things called matching, where they'll match 3% of somebody's annual salary. So if you put in $10,000 a year, they're going to give you $300 US match. There's usually caps. Every company's different, but 401ks in the U.S. make up billions and billions, and probably hundreds of billions of dollars, maybe trillions of dollars of investment capital that goes into stocks and shares and other things. But they are warning over risky alternatives in 401ks because the U.S. government really wants to watch out for you. They're saying that there are certain categories of investments that people should be warned about. And they say that they are exposing these hard-earned savings to volatile financial instruments while attempting to rebrand them as alternative assets. What kind of things are they? Things like private equity, rely on long-term capital, and they are very illiquid, which is very interesting, that word illiquid. As you will know, liquidity is extremely important when it comes to investing. Some of our peer-to-peer lending platforms have really good liquidity, where other platforms basically have none because you're waiting for the loan periods to end. And those are companies that do not have secondary markets. So you're going to get non-guaranteed, really good liquidity through a company like LoanPad, but a company like Crowd Property, you're going to get very illiquid product. So that's why they mention illiquidity. And that can be a concern if you do need to access your money and you're not able to get it. Being illiquid is not such a great thing. So they are trying to warn against these types of products, that they may be illiquid and they may be concerning for people to invest in. And look at this. The order opens up $12 trillion of market to alternative asset managers, with cryptocurrency among the assets now permitted. So $12 trillion, that's the 401k U.S. retirement market for company 401ks. Also, if you are somebody who works for themselves, you can open one of these 401ks. So that's a pretty interesting story. This is the Land Invest monthly fact sheet for September 2025. They just give a little roundup of what they have done for the month of September. 13 investments posted. Average investment amount £166,000 per investment. 7.5% annual return average for those investments. Average loan to value 71%. You can see here the geographical exposure with the rings. You got some in Scotland, 1.2 million, and then the East, 651,000, so on and so forth. Now, we take a look at the live investments here. We see that I think some of these numbers have gone a little better with, especially the enforcement, 5% now in enforcement, 7% out of term, 7% in arrears. LendInvest is kind of on my, can I say the word shit list at the moment? Because me being out of the country part of the time, I've been having a very, very difficult time logging into LendInvest. In fact, they locked out my account for several weeks because I wasn't able to give them a working UK phone number. When I'm in the US, I don't have a working UK phone number. And so now they have enabled two-factor authorization through mobile phones only. So if you don't live in a place where you can get your UK phone number to work, you would not be able to access your LendInvest account. So they have not enabled something like a Google authentication app to be able to solve that issue for people like myself. So I'm just not able to log in to my LendInvest account, which really is not such a great thing. I still like LendInvest. I think it's especially since interest rates have dropped and you're going to see them continue to fall. I believe there'll probably be another rate cut by the end of the year. If I were a gambling man, I'd bet on that. And 7.5% isn't looking too bad for the type of product that LendInvest essentially offers. Let's talk about London House Exchange. I got to tell you, I think that this might be a side of the companies that have gone into administration. London House Exchange, also known as Property Partner, which I used to be really, really excited about, right? I'd visited the company, I'd met with the CEO, and I thought, this is a good idea, right? You could buy shares in properties, and they were using some leverage, which creates other opportunities for them to acquire more properties. And I was thinking, this is back in my completely novice days of doing this, when back early on. I don't know. I mean, let's see when I last sold something on it. It was 2019, but I think I started maybe in 2018. And I sort of took a bit of a flyer on this company because I like the idea of owning property shares. If I'd have really thought it through properly, I would have realized that this was a method that couldn't be a good one, because number one, it's like stock picking, right? If you have to try to pick out which properties were going to be the right ones to pick, there were so many that you would have a very difficult time, because you're going to pick some good ones, you're going to pick some bad ones, and the returns overall are just not going to be very good because of that. Now, I've heard some really bad horror stories about people that went very heavily into just 2 or 3 properties, especially the London-based ones, who got a bit hit on the chin in a couple of those. And then I heard about people who took small pieces of cash and invested it across 30 or 40 properties and did okay. They were making like 6%, but it was a lot of hassle, and the amount of time you had to spend making all these transactions. And the bad also problem with London House Exchange was the secondary market created some weird pricing situations where, based on demand and supply, people were selling their shares cheaply, which caused the prices sometimes to crash. Other people were making profit on their shares on the good properties, but the ones that were doing poorly really tended to suffer. Also, with the leverage, what happened was when interest rates went up, London House Exchange realized we can't continue to service debt at 8% when the properties are making 4%. And this is a bad situation. Thankfully, they didn't leverage themselves too much, but it was still a problem. And it was something I identified when I did my review on Property Partner a long time ago, thinking the mortgages are probably going to be an issue in the future, but since interest rates were low, it wasn't too concerning at the time. As interest rates started to rise, they get lucked into these high interest rate situations, becomes a problem. But I'll show you my my portfolio here if you did not invest in London House Exchange. Hopefully you didn't. But you can see here my overall total return, right? This was from £2,469 that I put into Property Partner. Is that a big amount? To some of you, maybe. To some of you, it may be just a little piddly amount. To me, it was something, and I lost so far. Minus, I've got £274 of capital gains, right? But I've made £294 in dividends, and my total return has been £20 and 31p. So we are talking 7 years. If I'd have put £2,469 into my trusty U.S. equity index tracker fund, that $2,469 would have probably been 2.5 times worth that. But instead, for my own personal research and for your entertainment, I put it in here and received 0.82%. So some of my worst and best performers were right here. And this is the problem, like I was highlighting. Some did well, some did terribly. My best performer was Golden Fort, Hill Fort, 38%. Problem is I only had £8 in there. And then you can see here, these ones did okay. I had £100 in Sanders Maltings, or it made 20%, £100 in Kings Highway, that made 24%, £177 in Finch Heights, it made 7.35%. But then when you go to the bottom area, you have £109 in one that lost 52%. £164 lost in Boyd Street in London. It's one of the poor performing London properties that I know some people put some serious amounts of cash into. And this really highlights the difficulty of trying to pick out which properties, and again, correlates with stock picking. You're going to have tons of different options to pick from. And unless you're some super math accounting genius where you can figure out this is going to work or not in advance, you're probably going to end up with certain results like I did, which is in the negative. Now, where does Property Partner / London House Exchange go from here? I think they have a very big problem on their hands. If you came to somebody like me and said, do you want to continue investing in our new products whenever they come to light? I'm going to look at my 0.82 return and say, oh, heck no. Why would I put money into this product? Obviously there's been some severe issues, whether that's from the people running the company picking the wrong properties, whether it's been mishandled, I don't know. Maybe it's a result of the UK property market, but it's not looking good when you say, do you want to invest again? You've made 0.82% over 7 years. My answer is a hard no. I'm not coming into this product again. So when all of these properties get sold off, and what I'm noticing is as they go to vote, people are voting sale every single time because they want to exit, right? Some people are going to be happy to get out even with what they put in, but none of these properties are being held. If they were good products, people would be voting for them to be held and to be kept. But as far as I can tell, they're all getting voted to sell. Some people are willing to take a 52% haircut, like on this one. They voted to sell just to get half of their money back, right? So what's the future? I mean, I don't see really a future for London House Exchange unless they've got some crazy investment thesis idea that they're going to introduce to people. I'm just not seeing it. I'm not seeing that that's going to happen. So pretty disappointing, right? Pretty disappointing results for what could have really been a fun and an intuitive way to invest, I think. And I don't know. I'm disappointed. I'm disappointed in it. But what are you going to do? This is about learning, right? This is about learning. This is what we do. We learn from mistakes, and don't try not to make them again. So I don't know. We'll see. Anyway, also they put out a report of their portfolio recently, and they've sold 41 residential units in Q3 of 2025, 5.9 million pounds, right? And as a consequence, they paid 3.3 million pounds down on the mortgage. They tried to put some things in a positive light. We paid another mortgage bond, with bondholders achieving a total return of 11.1% on the amount repaid. Another successfully completed finance investment, blah, blah, blah. Not really interested in that. I didn't invest in those, of course. And then you can see here, they've got 118 properties let, 5 vacants, 30 for sale, 49 under offer. So they have a long way to go, right? They've still got 202 properties under their ownership that some of them are paying small dividends, some of them are losing money. The rent has contracted by 0.4%, right? That means the rent's gone down. That's not good. Across these completed sales prices were 17.2% below their vacant possession value and 9% below their purchase price. So that means people are losing money. Blah, blah, blah. Mortgage debt. Dividend distributions will remain the same. Doesn't really talk about, what is going to happen in the future to this business. So we'll see. They still have these properties with fire safety issues too, which is that's going to cost more money, right? They got to do remedial works to 5 properties, and I'm assuming these are quite big. Let's have a look. Oh, look at that. You have to do remedial works to that, right? The Edgware house. Look at that. This is what's going on. Right? This is the kind of example right here. Check this out. This was a 50, I don't know what it went up for. I don't know if this was the price that it was released at. 52 pence per share down to 7p. So everybody who invests in these is, well, not everybody, but most people have lost a lot of money. That's disgusting. It's like 80% gone. So, boo. Yeah, anyway. Yeah, London House Exchange, sorry, but not happy with you. And I tell it like it is, right? I'm transparent. You see my dashboard. It's transparency. I'm showing you how much I put in, what I gain. I show you the goods and the bads. It's not all goods. There's some goods, but not all of them are goods. Funding Secure is getting administration extended until 21st of October 2027. I think it'll go on beyond that, but there you go. That's continuing to move along. That has been actually not too bad. This is my dashboard for Funding Secure. Right now, I only have 80 pounds left stuck in this platform, so I managed to get a decent amount of money back out of here, and these frozen funds were removed too. So I'll show you that, talk about that in a minute, but that's been pretty good as far as administration goes. For me, again, there's going to be people who invested in bad loans that really stuck in the negative on Funding Secure. So it's the difficulty of when you're doing self-select lending, you pick the wrong things in the wrong company, you're going to have problems. Let's we'll skip over that for a second. Let's do the LoanPad update letter. They send these out every once in a while. Just a little update. You know, I'm a fan of LoanPad. I think slow and steady wins the race. And you're not going to get the best returns in the industry, but you're going to get up to 6% on the 60-day notice. I think that's pretty good. The loan portfolio continues to perform well. We do not envisage any losses on existing loans. That is how you do peer-to-peer lending right. 279 loans in the portfolio, which means you are invested across all of those. That's beautiful diversity. 0.3% of your invested funds go across each loan, approx. 420 million pounds value of loans now. Repaid. 300 million repaid, no losses. How many platforms can claim that now? Not too many. 220 million is the current loan portfolio. 21 lending partners. Interest rates 5% on classic, 6% on premium. So there you go. Doing pretty good. Let's oh yeah, Funding Secure. So this is an update. What was going on with the frozen funds? For anybody that was probably invested in Funding Secure, there was a pretty long period of time where these allocated funds right here on the right were showing frozen. I think I didn't have much in there, maybe 85 pounds, but it was stuck for a long time. So they cleared that through the court system. There was an email that went out and said they've now figured it out, less than 3.11% deduction. So if you haven't logged into your Funding Secure in a while, go in there because you may have some money in there that you can withdraw. So that was good. They got that completed. That was the frozen loan, the Quist close, I believe there. So look at that, 901 days active, 3 years, right? I lost 1.2%, which, hey, I'm ecstatic to get 1.2% back on that. It says actual return was negative 3.1%, so it depended when you went in there and how much interest, blah, blah, blah. But I was ecstatic to get a little bit of cash back out of that situation. So that's okay. Funding Secure. Yeah, let's look at the money platform. They sent out an update. I've never invested anything through the money platform, but I have some of you guys I know write to me and tell me really good things about the money platform that is very fast moving, high interest rate loans. So they sent out an update. If you haven't seen it, shorter days, quicker matches. So our larger loan sizes continue to see shortest queue times, so less cash drags with fewer lenders competing in the space. We continue to see our mid-prime lending product, longer, larger loan, thrive. Last month, £140,000 lent to mid-prime borrowers. So they're offering that. Now they're making further improvements to the My Stats page. September, they lent $1.666 million, 3,003 loans, forecast gross return 2025 to 2026, 16.9%. That's pretty good. You do need to be diversified on that platform because some of those, if you don't have a big enough loan pool of several different loans, you are going to probably see some returns that are not as good as 16.9%. Same like anything, you probably need to have a pretty decent amount of money on the money platform to be well diversified. So don't go in there with $1,000 and expect that you're going to, get 16.9%. You're probably going to pick some bad loans and get yourself in trouble. So make sure you're diversified. Yeah, if you're enjoying the content, by the way, hit the thumbs up if you haven't. I appreciate that. I really do. We got a letter in the mail. Let's go to the mailbag. This is a good one, actually. It's quite timed well. Lawrence, trust you are well. Yes, I am. Thank you, Sue. I feel as if the peer-to-peer lending space is very stagnant. Do you think there's any growth or any possibility of growth in this sector? I've been in peer-to-peer since 2018, but I'm honestly thinking about withdrawing completely. I'd be interested to hear your thoughts. Yeah, this is a common question that I've read a lot on the forums about stagnation and people saying, you know what, I've just kind of had enough. It's not doing very well for me. And nobody can really tell you what to do with your investments. I think some people are very loyal, right? They have been with a company and investing in their loans for such a long time that they feel sort of this loyalty to continue. But I've always said, if you don't feel comfortable, there's nothing wrong with withdrawing. You could always go back in. From my experience, once you go out, I don't think many people tend to go back in. Tell me what you think about that. But I definitely can understand that you would feel the space is stagnant. I kind of have a bit of a different perspective. What I feel like has happened is you had a lot of players jump into the market when it was the hot sector in the UK. It was the new thing, 2017, 18, 19. New players coming in to a upstart sector. And then you had a lot of players and a lot of companies that really couldn't produce a good product. And you started to see a lot of companies disappear or go out of business voluntarily or involuntarily. And then you've really got to understand this space. If you were thinking about starting a peer-to-peer lending company, you'd have to really understand the space well to want to enter it. And if you were looking at the news and the negative sentiment of people saying, well, it's not growing and the company's going out of business, as a new player in the business, you probably would say, maybe there's better opportunities elsewhere. Do I want to open a peer-to-peer lending company during the time of negative sentiment? I would say most people wouldn't want to do that, which is why you're seeing that stagnation and not too much growth. And I think the crowd tends to move together, right? I mean, if we take stocks right now, technology is very big, right? Back when we were doing well with the trading 212 portfolio, it was oil. Oil was the thing, and the crowd was moving towards the oil stocks, and the oil stocks were really moving. Now it's AI, right? Technology. The crowd is moving, and I think the crowd has somewhat moved away from peer-to-peer lending, and that creates some negative sentiment. Is there any possibility of growth? I think there is possibility, or I think is more likely, as Neil from Fourth Way said, you're just going to see the companies that are solidly placed in the marketplace continue to do well. And you might see a couple of new players come into the market here and there, but I think in general, this might be what you see for now. And I think the best way to handle your portfolio is to focus on high-quality peer-to-peer lending companies that have been in the space for a while and have a history of doing a good job. So who is that? Well, LoanPad. And then again, this is not me telling you what to do. This is not financial advice. It's just my opinion. Who's doing well? LoanPad, Unbolted, Housemartin, Blend Network, Propland, Folk to Folk. Companies like that. They have a history, right? They've been doing it for a while, and they're experts in their field. All right, so if you really want to learn about these companies, it's like a stock, right? A lot of people, including myself, sometimes I invest in things that I don't fully understand the business, and then once the stock deteriorates, I'm kicking myself going, I should have really understood more about the company. Same with peer-to-peer lending, where I went to LoanPad's offices and I sat down with Louis and I got a sense for his experience and how he understood the market, And I've certainly had the wool pulled over my eyes, right? I've visited Assets Capital several times and was led to believe they really knew what they were doing in the market. Turns out they wrote a lot of bad loans too. But you have to gauge the information that you have, and when you meet the people running the companies, you figure out this person knows what they're doing. Some of the other companies that have voluntarily liquidated, Lambay, for example? I really liked him. I thought he really knows what he's doing, and he did, right? So sometimes it's really hard to gauge whether companies do know what they're doing and the people running them know how to do it well. So I'm in a pretty lucky position to have been to some of these offices directly and spoken to the people who run the companies, but I get it wrong too. I mean, that's the truth of the matter. Wool can be pulled over the eyes, but I would say do your research, and especially if you're planning on investing any significant stake in a company's loans, you should probably call them up and have a conversation. Maybe even take the time to go by the office and meet the people running the companies and do your own due diligence and research. I think a lot of people won't do that because they're probably not investing a significant amount, but if you are, I highly recommend that. So that was a long answer to a short question. Do I think there's any growth? Right now, no. I think there's just stability in some companies and possibility of growth. Yes, but I think it's going to be small. I wouldn't blame anybody for withdrawing, but I think what's going to happen too is when the stock market's volatile like they are now, people will come to safe havens where they can get that fixed income, because bonds have sucked. I mean, you buy a index tracker bond for the last 10 years, it's just really done poorly. So you could come to a place like LoanPad and get 6%. It's pretty nice. So volatility in equities goes up, and stock market's not doing well. Products like P2P lending benefit from things like that. When the stock market's raging and doing really well, people pulling money out because they want to get rich quick, investing in stocks. So hope that answers your question. I did pull some numbers too. So as you know, I tend to check LoanPad every once in a while to see how things are going with their statistics. So we'll take a look today, and you can see here 5,285 total lenders, right? So I decided to go back and check some of the past streams that I've done, what that lender amount was like. And this is a really good way to check and see growth, right? Is a company growing? Because lender amount, while it may not be the be-all and end-all number, because the average lender may be putting in more money and they could have less people taking these loans, right? Investors like me and you, but they could be putting more money in as they become more comfortable. That was what I did. I started with a small amount and increased it. So you may have less lenders putting in more money, but I think it's good you can see how many lenders and how that's changing. So I'm just going to show you some screenshots here. This is July 2024. Look at that, 6,220 lenders and LoanPad, so you can see that's dropped. And I still love LoanPad, but I'm going to be very transparent and say, hey, this is just the facts, right? They had 6,220, and so they've lost almost 1,000 investors since July 2020. Now we go back to July 2024, 6,220 lenders, and January of 2025, 5,752. So it's even down from then. And then we go October 2025, 5,244. So it's increased, 39 investors since just last month. So that number is fluctuating, but it has generally dropped from July 2024. That could be negative sentiment towards the peer-to-peer lending space, or because people are pulling out money that they need to go invest in other things like stock market bull runs, blah, blah, blah. Let's talk about a couple of other things. Look at this. Our favorite iWeb. Well, it's definitely not our favorite, but this is where I first started investing for £5 per share transaction. They got taken over by Scottish Widows, which I didn't even know did share dealing. Nothing has really changed. I was going to say maybe one good thing to come out of it was that iWeb would offer a decent trading platform interface, but I logged into my iWeb. This is what I saw. I'm going to show you. Hold on. Let me just put the sensitive details in. If I can remember my sensitive details. There we go. Look at this. This is what you get when you go to iWeb. A very confusing, minimal platform that looks like it was coded in 2001. You want to buy some stocks, you can. They do have a, look at this. Look at this. This is so bare bones compared to something like Trading 212. Like, you just don't get much. You're going to pay £5 for a trade too, so unless you're doing continuous auto invest, then they'll do that for you for free. But who wants to pay £5 for a trade when you can get it for free in some cases? I just don't think it's a very good value proposition right now. There's just so many better platforms. I'm surprised they're still in business. It's kind of crazy to me, right? But there you go. This is the place I made my first stock purchase. I've shown that on the stream before, so I do have a little space in my heart for iWeb. But they've gotten taken over by Scottish widows. Scotland, from Scotland. Let's go back to the mailbag. Here we go. Hi, Lawrence. Missed not seeing your YouTube last week. Sorry about that. You know, times where I'm not always able to be here. Hope you're back soon. I am. Phil in Eastland, back now. I'm freaking out. All of my stock investments are dropping. What's causing this? Should I cash out and sit on the sidelines? Probably a silly question, but I need some calming right now. Thanks, Phil in Eastleigh. I wish I could tell you what the right thing to do is, Phil. I can't. I don't know. I don't know the answer to this. But what I do see is something interesting. If you go look at the charts, this is the S&P 500 from 1 year ago, back here in the 12th of November 2024, when the price right there was 5,975, the S&P 500. Right now we're sitting at 6,715. Look at that. Boom. Right? 6,715. So you've seen some growth. Right? You've seen some nice growth. So sometimes when you're freaking out, you just have to zoom out. And if you look at from when we had that nasty correction back in April, it's gone up almost 2,000 points, which is a crazy bull run. April to November, 2,000 points. That's like 40% if you manage to time the bottom. But whenever you freak out, the best thing to do is just zoom out. Look at that. You zoom out. A lot of the problems with the stock market is perception. People think, oh, I started with 10,000. My portfolio went up to 15,000 and now it's back to 13. So you're thinking about the 15. You're not thinking about the 10 that you started with. You're getting this perception of fear. And fear is a very real thing. It can really screw up your investing. It's done it to me. God. Listening to other people can really mess up your perception. I think the best thing is you buy things that you have a long-term conviction in, and timing the market is futile. It's very difficult. I've tried it, believe me. But I certainly understand that fear. I mean, I get the same fears, but if you're a long-term investor, the best thing to do, buy yourself an index tracker. Just keep buying as long as you can, and then don't do anything. Just sit on it, right? If you look at our U.S. equity index tracker, right, we're sitting at 1,143 pounds. That's pretty good. Just a month ago it was the same. And it's just continued to do well. That's because even if you sat on it since January, let's look at the price in January. Look at this. 1,056. So if you sat on it since January, you would have made 10%. Just sitting on your hands. And if you're able to buy some of these low points, right here, when you had those opportunities in April, 864. So you would have done even better. Now, if you're going to do something crazy like I have with the Trading 212 portfolio, which is stomach churning for me, right? You're going to get some crazy swings. I was feeling so good about this portfolio the other day. It went over, I thought it went over 31,000. It did go over 31,000. I don't know why this chart is showing otherwise. But, I think this is just showing my investments because I've cashed out some cash. But it was over 31,000. It went to 31,500. And then it's now 28,891. And just earlier today, it was 27,500. If you're going to make investments like this, which I don't recommend anybody does, you're going to have stomach churning moments where you feel like selling everything and cashing out, right? Look at some of these numbers down here. We got some new positions here in the portfolio. Nebius Group. I decided to try something else. I decided to do something silly, which is follow the crowd. The crowd seems to be making money online. You know, the Fit Twin, they call it FinTwit, financial Twitter. And the crowd seems to push these share prices. So I thought, you know what, let me try. I'm going to just take, 3,000 or 4,000. I'm going to put it into some of these crowd stocks that everybody's talking about. I did a little bit of research, just a little bit, a couple hours here and there, just to see what these companies do. And I bought some Iron shares, right, which is a NASDAQ traded company. And I did okay. Look at my entry point, $53.31 right now. The stock is trading at 64. And it got up to $78. I thought I was a genius. That is just called luck. Good timing, right? And I did it with Cypher Mining. This thing was at $22 at one point. Actually more. Look at that. $25. I thought I was a genius. It was just good timing. Then we had the negative red ones right here. Look at this. Nebius Group, 13.3% in the red. Photronics, 11.24% in the red. And Rocket Labs, this was down to 25%, I think, at one point in the red. Now at 18%. So this is the problem. You can get very high risk, high reward plays in stocks that will make you have these stomach churning moments that you are probably not going to want. Whereas if you just put it in an index tracker, you're never going to have to worry about it. You're probably not going to get rich. You're not going to get, you're not going to have trades like this NVIDIA trade that made you doubled your money, right? This is just luck and good timing. Look at this strategy trade. Negative 27.68% as Bitcoin has gotten hit pretty hard, and strategy itself has had a really tough time with the stock price. So if you want to have those stomach churning moments, you just throw darts at the board, do your research. Maybe you're better at this than I am, but I don't recommend it. I would never put all my net worth into some kind of stock portfolio like this. I'd have the majority of it into a index, like a Vanguard index tracker, and then have a little bit of play money. If you feel like you need to have that gamble money, sure, go for it. But I don't know, Phil, what to tell you about that. I don't know what type of investments you have, what type of stock. If you have index trackers, just sit on it. You're not going to have a problem. If you have good blue chip stocks, maybe like Amazon and Facebook and Google, those companies are not going anywhere. You sit on it and you wait. If you're gambling and you have some silly trading stocks like I do here, that's a different conversation. So, and I don't know how much that money means to you. That might be 10% of your entire net worth, and I tell you to sit on your hands and do nothing. If it's 80% of your net worth, then you need to make some decisions. But yeah. Okay. Let's look at Bitcoin. We have to look at Bitcoin. It's very interesting. Bitcoin has had a rough time over the last couple of weeks. Dropping a lot, as you can see here from the chart. our speculatively volatile friend, Bitcoin, right, hit its high of 124,000. Everybody thought this product was going to the moon. Everybody was excited and happy. And then we had this pullback where people started to sell. And then it came back and gave a little bit of ray of light up to 114. And now we're sitting at 103, and it has dipped below the $100,000 threshold, which is extremely mental support level where people go absolutely ballistic when they see Bitcoin go below 100 grand. You've got your savvy investors who say, this is maybe a buying opportunity, right? And then you got your people that have not been in it for too long saying, oh, Bitcoin's dead. It's over. This is the end. Which, by the way, I've heard that narrative story for 10 years. What I have generally found is that when this fear and greed index sits at this low point in the red, right now it's sitting at 21, this has historically been an excellent time to buy some Bitcoin. Every time I've looked at this fear and greed in the 20s, I have watched Bitcoin's price go up. Every single time. Is this time going to be different? I don't think so. I'll tell you why. Because you have President Trump's son, who has a cryptocurrency business, talking about Bitcoin everywhere he goes. And this is just one person. But he is educating millions of people. And I say sometimes you just have to follow the money. Whatever you think about things, right? There's people that invest in stocks that the stocks are just bad stocks. What is a good example of that? Like Duolingo. I've seen people just saying great things about Duolingo stock, which I don't know anybody that uses the app to learn the language. They're doing other things too. But you can make money in these sectors if you follow the money. And when you have the president's son and the president tweeting about Bitcoin, kind of makes sense that the money follows, right? It's no coincidence that Bitcoin's price has gone up. And he makes some really good points about banking, right? And there are some things about the banking industry that are just so archaic. If you want to send money to somebody at 6 p.m. on a Friday through a bank, so you want to wire money, like in the UK, I think the UK is generally a little bit better with banking than, say, the US. But if I want to send a wire transfer at 6 p.m. on a Friday, that's not going to get there till Monday because the banks are closed. It's very archaic. And Eric Trump realizes that there are better ways to send money around the world. I can send something to somebody in Africa in 10 seconds. That makes sense to him. That makes sense to me too. Right? There's just better ways of doing it. We're just not, as a society, ready for that in some ways. But this is, I believe, is going to be the future. You'll be able to send money electronically very quickly. There are some ways to do it right now. A lot of people don't trust those ways. There's things like Wise. You can do it. You can send ACHs, like internal bank transfers. But again, if the bank's not open, sometimes they don't come through till the next day. There are better ways to do things. So he's also saying that banking, these banks, they don't want to do things like cryptocurrency because they don't make fees. Like if a bank gets to sit on your money for the weekend, they get to sit on billions of dollars over the weekend. People are trying to send wires and it gets trapped in their system. They make short-term overnight interest, and that's the reason why they have these. That's what he says. This is what keeps their 70-story buildings lit and alive and makes their CEOs hundreds of millions of dollars a year. There you go. It makes sense to me. So you got people like him in the national media. You got the Financial Times talking about it. You follow the money, right? Follow the money. So there are good opportunities. This is a Financial Times article. A little life hack too. I don't have a Financial Times subscription because I don't really use it. But if you ever want to read an article, you can go to this website called archive.is if it's behind a paywall. I'm not saying you should steal articles or anything like that, but sometimes you just want to read one article or whatnot, and you don't have a subscription. Archive.is is a cool way to be able to do that. So you can see the Financial Times talking about 2 tiny banks that helped Donald Trump's sons build a crypto empire. By the way, there is some morality questions about, these companies too, and how Trump has been able to do that, but that's for another day. So when you have these types of articles all over the web, it's obvious where the money is going. And will that always be that way? Maybe not. Like I said, you follow the crowd. The crowd sometimes can jump on one thing quickly and then leave to something else very quickly too. So you have to really be on top of things. It's interesting, though. I find the whole thing fascinating. There's God knows how many now millions of these garbage cryptocurrency coins that provide no service and no value. So yeah, most of them will fail. Most of them will go down 90%. I mean, look at all these Bitten Sensor, Pudgy Penguins, Aerodrome Finance. They're all useless utility coins. They don't do anything. I don't think anybody could tell you what any of these coins does. So it's just speculative gambling. Bitcoin, I don't believe, is like that at all. But yeah, some of these, like 7 days up 135.3%. Just basically gambling. It's people gambling on this nonsense. Anyway, I hope you enjoyed the stream. Yeah. Hope you enjoyed the stream. One more reminder, hit that thumbs up. Holly is over there sleeping. I will try to get some more guests planned for the stream. I'm always reaching out to people, begging them to come on. Come on, please. Hey, Peter Vince from Leatherhead, how are you? Lawrence, can you investigate what's happening with Landlord Invest? The website is still up, but no activity. Let's see. What is going on? Yeah, I will investigate. You'll have to wait till next week, though, because I don't know the answer to the question. It says to comply with FCA regulations, I must tell them what type of investor I am. So I'm not going to do that right now, but I'll take a look into it for you. Come back the next time I stream, maybe next week, to get some answers. Dave Allard, crowd property update tonight. Another loss. Another capital loss of unknown amount. Interesting. Not surprised. I mean, I think we all knew that crowd property was having some troubles. Capital rises at a flurry of loans, launch, bridging, and mezz. Can you recommend a best place to buy a simple crypto ETF? I don't know that you can, and I think there's, in the UK, they haven't launched yet. I think BlackRock is going to be launching a crypto Bitcoin ETF. Crypto is encompassing all that other nonsense that I do not touch at all, but Bitcoin ETF, I think, is going to be launched in the UK. I thought it was going to be October. Let's see here. Oh, here you go. They already released it. I did not know this. If you want to do it, we'll look on Trading 212 and see if it's a BlackRock iShares Bitcoin ETP is listed on the London Stock Exchange, now available to UK retail investors. 100% physically backed by Bitcoin, held through Coinbase. So what is the ticker? iBit ETP. Let's see. So it's been listed. I don't know if it's been released yet. Let's have a look. Let's see if we can find it. There we go. Check this out. This is interesting. The market is yours. What the future might hold. Let's see if we can find it on Trading 212. iBit. There we go. Look at that. You can now buy this product, which is purely a Bitcoin ETF. It's an accumulation product, and you can get it at a 7% discount. So there you go. Let's see here. Expense ratio 0.15. So we've got £500 million right now. Assets under management. Yeah, I don't think it's really well known. I didn't see much about its release, so it's been quiet. But that is a very reputable company to be able to own and get exposure to Bitcoin without having to own your own Bitcoin through Coinbase. So there you go. Let's see what it's done the last week. It should be pretty nasty because of the drop. So there you go. You could, if you're a long-term holder, you can buy in at 8% under. I might have to snag myself some of this 8% discount. I do like that. So, yeah, good question. Thanks for bringing that up. Hope that answers you. Yeah, so IB1T on platforms. I'm presuming most of the major stock trading platforms are going to offer that. So IB1T. You can have a little nibble at some Bitcoin exposure without having to hold it. Pretty cool. There we go. Show that to you. Okay. What else? Free MP3. Don't know. Trading 212. Yep, you can get it on Trading 212. No withdrawal button on the Cufflink platform since last night. Is that true? Is that really true? Let me see. What's going on with you, Cufflink? I'll sign in. Let's see if there is a withdrawal button. Hope you got some fun things planned this weekend. I don't. I'll be working, but withdrawal. Let's see. Yeah, it's there. It's right there on the left. Let me zoom out. You can see right there. Right over here on the left is the withdrawal tab, and you can withdraw. So the button's there if you want to withdraw. Maybe you do, maybe you don't. Maybe you will, maybe you won't. Anyway, that's all I got for you. Hope you enjoyed the stream. Subscribe if you're not subscribed. Some of you are not subscribed to the channel, which I find like crazily mind-blowing. Subscribe. Don't make me yell at you. I'll see you next time. Maybe next week, maybe 2 weeks from now. Coming up into the vacation time right now. And holiday period. It's almost Christmas. Can you believe that? That's crazy. Anyway, that's all I got for you. I'll see you next time. Take care. Bye-bye.